In this session, I want to walk you through one big building block of the travel, hospitality, and leisure sector, what we call physical destinations and venues. Think of this block as the hardware of the experience economy. Travel platforms, booking apps, and loyalty programs help you decide where to go. But the money is finally spent in physical places. The room you sleep in, the ship you sail on, the theme park gate you walk through, the arena where the show happens. That is the world we are analyzing today. Before we zoom into business models, it helps to see why this block matters at all. If you look at the slide with the large 10% and 357 million numbers from the World Travel and Tourism Council, you can see the scale of the overall sector. Travel and tourism now contribute around 10% of global GDP, close to 11 trillion United States dollars, and support roughly 1 in 10 jobs worldwide. International visitor spending has also been growing double-digit in the most recent year. This block, hotels, resorts, cruises, and big entertainment venues, captures a very large share of that spend. Hotels and resorts alone are estimated at roughly 1.7 trillion United States dollars of revenue in 2024. Theme parks, live entertainment venues, and cruise lines add many tens of billions more, so for a long-term investor, this is not a niche. It is one of the main ways to participate in global growth in travel, leisure, and experiences. Within this block, we can think of 4 main groups: hotels and lodging, resorts and integrated casino resorts, cruise lines, and entertainment venues and theme parks. They all share a common pattern. They are capital-intensive operators. They either own or lease land and buildings, or in the case of cruises, very expensive ships. They employ large teams, and then they try to maximize revenue per unit, per room, per cabin, per ticket, per seat. Unlike a booking platform that can shift focus from one destination to another quite quickly, these businesses are locked into a location and concept for decades. The bet is made up front in concrete, steel, and debt. Let's start with hotels and lodging, because they are the backbone. A typical hotel makes money from a mix of room nights, food and beverage, events and conferences, and other services such as spa, parking, or small retail. The key metric operators watch is revenue per available room, or RevPAR. It combines the occupancy rate and the average daily room rate. RevPAR tells you in one number how well the hotel is converting its fixed asset into revenue. Industry data shows that global hotel RevPAR has now moved above pre-COVID levels, mainly because room rates have gone up. In many markets, occupancy is still a little below 2019, but higher pricing has more than offset that. On the balance sheet, this is a classic asset-heavy model. Capital sits in land and buildings, and every few years you need fresh capex for refurbishments. In many cases, ownership and operation are now separated. The brand, think of the large global chains, may not own the hotel at all. It earns fees from management contracts or franchises. The property owner, often a REIT, private equity fund, or local investor, takes the more volatile property-linked return. So as investors, we need to be very clear whether we are buying into the brand and fee stream or into the asset and its leverage. The risk-reward is quite different. Resorts add another layer. They are not just selling a place to sleep. They sell a destination and a package: the beach, the spa, the kids, club, the evening shows. Global resort revenues are already in the hundreds of billions of dollars and growing strongly, especially in beach and eco-resort formats. Operators are also leaning into all-inclusive models and lifestyle brands, because these encourage higher and more predictable spend per guest. Integrated casino resorts go one step further. Here you have gaming floors, hotel rooms, restaurants and bars, luxury retail, and shows and events. Gaming spend worldwide is a large and growing pool, with casino gambling revenues in the hundreds of billions of dollars. When regulation and visitation are favorable, these resorts can generate very strong cash flows. But the capital intensity and regulatory dependence are both high. Licenses can change, tax rates can move, and governments can push operators to diversify their offer. For investors, this is a world where you have to be comfortable with concentrated regulatory risk and large single-asset exposure. Now let's talk about cruise lines, which are best thought of as floating resorts. They deploy multi-billion-dollar ships with high fixed operating costs. Profitability depends on keeping occupancy high, driving onboard spend on drinks, excursions, and retail, managing fuel costs and port fees, and growing capacity in a disciplined way. If you look at the slide titled Global Report 2019 to 2024, with passenger volumes, you can see how violent the cycle has been. Passenger numbers dropped sharply in 2022 versus 2019, then rebounded to about 31 to 32 million in 2023 and around 35 million in 2024, now above 2019 levels. Average trip duration is stable at about a week, and the average age of cruisers is in the mid-40s. That chart captures the key message. Once the health shock passed, demand came back strongly. But during downturns, these are very painful businesses to run because ships cannot be moved out of service cheaply, and the cost base is largely fixed. The next group is theme parks and entertainment venues. Theme parks make money through ticket sales, food and beverage, merchandise, and premium experiences such as fast-track access or special events. If you look at the chart on theme park market size, the one showing 2023 at about $52 billion, 2024 at $56 billion, and a projection to over $120 billion by 2032. You can see the story visually. The implied annual growth rate is a little above 10% over the period. That is well above expected global GDP growth, reflecting the shift toward spending on experiences. Live entertainment is on a similar track. The chart shows market size rising from roughly $190 billion in 2024 to around $270 billion by 2030, at a compound annual growth rate of about 6%. The stacked bars highlight North America and Europe as the largest markets today, but Asia and China are meaningful slices and are likely to contribute a growing share of incremental demand. For investors, the key question is whether the venue or park has must-see content or intellectual property that keeps drawing audiences back, or whether it is just another generic event space. The former can sustain pricing power and high utilization. The latter tends to be more cyclical and price-sensitive. Although the formats look different, the economics rhyme. Across hotels, resorts, cruises, and venues, 5 drivers are central. First, travel volumes. International tourist arrivals reached around 1.4 billion in 2024, roughly back to pre-pandemic levels. If you look at the UN tourism chart on recovery of international tourist arrivals by region, you can see that the world as a whole is about 99% of 2019, with the Middle East already far above, Europe slightly above, the Americas just below, and Asia-Pacific still around the high 80s. That regional dispersion matters a lot for specific assets. Second, pricing power, the ability to raise room rates or ticket prices faster than costs. Recent years have seen average daily hotel rates doing much of the heavy lifting, even where occupancy is not yet back to peak. Third, utilization, occupancy, load factor, or seat fill. Because the cost base is fixed, small changes in utilization can drive big swings in margins. Fourth, mix and ancillary revenue. Gaming, onboard spend, food and beverage, events, and retail often carry higher margins than the basic bed or seat. Well-designed ecosystems push guests towards these higher margin spends. Fifth, capex discipline. Overbuilding in a destination or overspending on trophy projects can depress returns for a long time. The sector's history has plenty of examples of over-optimistic capacity additions. This block is also one of the most cyclical parts of the travel, hospitality, and leisure sector. Revenues rely on discretionary trips. Costs are largely fixed: buildings, ships, staff, and maintenance. So when real incomes fall or unemployment rises, occupancy drops, discounting returns, and profitability falls faster than revenue. Higher interest rates add another layer. These assets are often financed with debt. When rates rise, the hurdle rate for new projects increases, which over time can slow new supply. But in the short term, debt service burdens go up, pressuring weaker balance sheets. Fuel and utility prices are also important. A spike in fuel hits cruise margins very quickly. High energy and labor costs squeeze hotel and venue margins unless operators can pass them on. At the same time, if you look again at the global charts from UN Tourism and WTTC, the direction of travel is still positive. International arrivals are effectively back to pre-COVID levels, and travel and tourism GDP is reaching new highs. So the structural demand backdrop remains supportive, even if the journey is bumpy. Beyond the cycle, 3 structural themes stand out. First, the recovery and reshaping of global tourism. The UN tourism charts show that recovery is uneven. The Middle East and parts of Africa are well above 2019 arrival levels, Europe is slightly above. Asia Pacific as a region is still below. If you look at the Asia Pacific slide with best performing destinations, you can see that Maldives and Japan are now well above 2019 arrivals, while some others like Malaysia, Korea, or Nepal are still below. For individual hotels, resorts, and venues, these differences matter far more than the global average. Second, the rise of experiential and lifestyle formats, especially for younger travelers. The theme park and live entertainment charts show solid growth expectations. Gen Z and younger millennials are willing to spend on festivals, destination events, and Instagrammable experiences. Resorts and hotels are responding with lifestyle sub-brands, wellness concepts, and spaces that blend work and play. All-inclusive and resort formats are gaining ground, as large groups invest heavily to lock in more of the guest's wallet. Third, sustainability and community impact. Popular cities and cruise ports are experimenting with limits on ship calls, visitor caps, and dispersion strategies to manage over-tourism. Energy efficiency, water usage, and emission standards are becoming central to hotel and cruise investment decisions. Gaming regulators are nudging casino resorts to diversify beyond pure gambling. These trends tend to favor operators with distinctive brands and experiences, not just generic beds. Destinations that can manage growth without political backlash, and balance sheets that can fund refurbishments and decarbonization without excessive leverage. Commodity assets and fragile regulatory positions look more exposed. Compared with millennials, Gen Z is more global, more digital, and more climate aware, but also more price sensitive. Millennials often grew up with traditional travel media and early social networks, and many built deep loyalty within a few large hotel or cruise ecosystems. Gen Z is more likely to discover destinations through short-form video and peer content, mix alternative lodging with resorts in the same trip, and value uniqueness and social proof over chain consistency. But both cohorts show a clear shift towards spending on experiences rather than material goods. That is helpful for this block in the long run. Over the next 1 to 2 years, the recovery phase is largely done. Conditions are likely to be, quote, steady to slightly better rather than explosive. Core behaviors, international holidays, city breaks, theme park visits, cruises, should remain intact. Operators will focus on yield management rather than pure volume growth, cost control in wages and energy, and selective capex rather than aggressive expansion. Undifferentiated mid-scale hotels in oversupplied markets or legacy offline distribution channels may slowly lose share. Assets that can still push price while keeping occupancy close to pre-COVID levels should compound cash flows. Over a 3 to 5 year horizon, structural trends will become clearer. We should expect steady growth in resort, cruise, and live entertainment spend, especially in Asia and emerging middle-income regions. There will be pressure on older, energy-inefficient assets, which may need heavy capex or be repositioned. Integrated lifestyle resorts, wellness-focused hotels, and event-led venues are likely to grow. Technology-driven revenue management and direct booking should be widely embedded, reducing dependence on third-party platforms for stronger brands. Over 7 to 10 years, the biggest unknown is how cities and regulators balance growth, climate goals, and community tolerance. Destinations that invest in infrastructure, manage over-tourism, and set clear environmental rules are likely to support a long runway of capex with acceptable returns. Places that ignore these constraints may face caps, new taxes, or political backlash. Cruise and resort supply will remain lumpy. New ships and mega resorts arrive in big chunks, so mini-cycles are likely. Live entertainment venues and parks that keep content fresh and culturally relevant should endure. Those tied to dated intellectual property may stagnate. To wrap up, physical destinations and venues give investors exposure to durable human desires, to travel, to relax, to play, to watch live events, but they do so through capital-heavy vehicles. The most resilient cash flows are likely to belong to well-located, well-run assets in supply-constrained or structurally growing markets, backed by strong brands and loyalty ecosystems, with sensible balance sheets and a clear plan for sustainability investments. Key risks to watch include overbuilding and poor capex discipline, regulatory tightening, particularly in gaming and over-tourism hotspots, climate and energy shocks, and shifts in how younger cohorts balance physical experiences versus digital alternatives. If we keep those questions in mind when we look at any individual hotel group, cruise line, resort operator, or venue owner, we are more likely to distinguish between assets that are simply riding the cycle and businesses that can compound value over the long term.